they do. Next slide. All right, so with that, I'm going to introduce our panelists for today. And this was thanks to one of you who said, hey, we need to learn something about crypto because it's starting to creep in to mortgage lending. So we have Corey Freyer, who is the Director of Investor Protection for the Consumer Federation of America and leads their efforts protecting retail investors, their retirement accounts, and overseeing the regulation of America's $125 trillion capital markets. And we also have Sharon Cornelison, who is the Director of Housing for the Consumer Federation of America, where she advocates on behalf of American consumers for fair, affordable housing and equitable mortgage lending. And at this point, I believe I'm handing it over to Corey.
Thank you, Ellie, and thank you, everyone, for having us here today. Always excited to talk about crypto, but also apologize that you have to hear about it finally. So I will try and keep this short and approachable, and sort of leave you with the takeaways that you need more than anything else. And I think, to that point, the top things I want to leave you with here through this discussion are one, you don't need to be lost in the technology of crypto to understand what it is as a financial product. It is in almost every way the kind of thing you have dealt with time and time again. And so I do not want anyone here walking out of this conversation to feel like they need to be intimidated by the technology, because that is not sort of the real point of what we're talking about when we talk about crypto. Um, and the other thing I want to say about crypto, and we'll get into the details of this, but sort of the second thing to keep in mind is crypto is exactly one minor and narrow thing, making it different from other financial products. But other than this one minor thing that we'll talk about, it is otherwise identical. And we need to look at it and treat it just like we would any lending product, any other financial asset. So even though we're sort of going to get into the weeds on some of this stuff today, I do want to make sure that, as you walk away from this discussion, you're taking away these high level points that what is not important here is the technology. What is important here is the elements of these products that look exactly like any number of financial arrangements or instruments that you have dealt with over time. And speaking of things you have dealt with over time, um, one of the other things I want to center this conversation around is that um, I hear all the time, and I try to correct all the time, this perception that in 2008 no one could have seen the crisis coming, that everybody was caught off guard, and I always remind people that starting in the early 2000s, there were housing policy experts and housing counselors and people on the ground talking to real Americans and real households waving the alarms around subprime lending and how, what was being sold as an idea for uh, extension of opportunity and inclusion was not always being executed in a way that was, faithful to that advertising and actually helpful to families. Um, I fear that we're in a very similar situation today. And in terms of making sure people are informed about the kind of risk they're taking on, that they have a real sense of what they're getting into when they start to rely on crypto in this space. And in terms of, interfacing with state and federal regulators about these issues, you are all such an important group. You were so important then, you are so important now. And so another part of this presentation is a plea for you to be involved. And again, not be intimidated by this technology. Trust your expertise, trust your gut on these matters. Um, so with all of that said, I think one of the easiest ways to think about crypto, most of what you've heard is talking about it as cash, right? As some kind of digital cash. I think a better way to think about it is if any of you here were really big fans of 80s action movies, like I was, um, both in Die Hard and in Beverly Hills Cop, the plot centered around a thing called a bearer bond. And what a bearer bond was a security that you could transfer between two people without going through any intermediary. It didn't have to go through the stock exchange. It didn't have to go through a broker dealer. It didn't have to go through a bank. You could take this interest in a company or a bond, and you could literally just sign your name on it and pass that over to someone else. And then it became their financial asset, their instrument. And so that is a peer-to-peer transaction of a financial instrument. This paper bond you sign, you give to someone else. Nobody had to be in the middle of that transaction, and the value has been transferred. Um, Crypto just figured out how to do that for electronic assets. So, what crypto does, and the only thing that is different about it, is it creates a new way to settle transactions where you don't have to have a bank or a broker dealer or an exchange or any other kind of financial institution to move that asset around electronically. The technology they put together to make this possible and to make sure you could move that reliably and to make sure people couldn't cheat on those transactions, they're all a really impressive technological advancement, but they are also just an iteration on technology in ways that we have dealt with new technology in the financial system before. So I like to point back to, prior to the stock market being made digital, being digitized. Um, Initially, a really great summer job for a young teen in the, 18th and 19th centuries was to wheelbarrow paper stock certificates between the exchanges and the clearing agencies and the clearinghouses of the day. All that paper would move around. We started building our laws with regard to securities while all of that was happening on paper. And then as it moved into a space where those transactions were happening electronically instead, we kept the vast majority of our laws about securities identical. Something similar happened with checks. It used to be that you would fly, thousands of pounds of paper checks across the country. It would take days, if not weeks, to settle them out and actually figure that money out of the banks. We digitized that system. You can now tap on a little black box with your phone, and no paper moves anywhere at all. That's all been digitized. It's all electronic. But the consumer protections that apply to those transactions, the way we look at what is actually happening, looks almost identical to the way we looked at paper checks when they were being transported across the country so long ago. And so when we think about crypto, we shouldn't think about technology as something that requires a complete rewriting of the financial system or rewriting of regulations. We need to look at the products for what they are and consider the technology as just sort of this iterative thing that has been happening over time that has some impact on consumers, sometimes requires us to reconsider small parts of our regulatory infrastructure. But ultimately, there's nothing new under the sun. There's no new wine here. And all of the tools we use to protect consumers, to evaluate financial decisions, they apply to crypto just as much as they would apply to anything else. Um, Being able to transfer these assets directly without any intermediary, without somebody trusted in the middle, actually does create a lot of new challenges to consumers. However, some of the risks, because of the technology is very complicated to transact in, is that it leaves consumers vulnerable to more sophisticated actors hacking them. It leaves them vulnerable to making small technology mistakes that could result in them transferring thousands, tens of thousands of dollars and never being able to recover it. Um, there are challenges with regulation of preventing money laundering uh, because, again, these transfers can happen directly between two parties over the internet, often nearly anonymously. And so we don't have the same kind of controls that we do in other financial marketplaces to track those transactions and to make sure everybody is following the law. So because of those challenges to that ecosystem, anyone who invests in crypto, any of your clients that are relying on crypto as part of their savings or might be interested in getting into crypto, they're exposed to this environment that can be a little bit more challenging to regulate than some other things that we have in the past. And also an environment where the companies themselves in the crypto space are actually very aggressively fighting against the kinds of consumer protections that they would face if they offered their exact same products in the traditional marketplace. And so there's a lot of risk here that we've all seen before, but is not being treated the way it has been treated in the past. And sort of that's one of the first things I would want to be looking out for in terms of the clients that you have is making sure that they are doing the same kind of analysis and making the same thoughtful decisions about getting into crypto as they would anything else. And as the last couple of weeks have reminded us, remembering that volatility and high returns always go in both directions, and there is no such thing as getting really high returns on a financial asset without also taking on a lot of risk. And so seeing through the hype and remaining really clear-eyed about what crypto is and is not is really important in having a balanced discussion about what is really going on in this space. Another really important thing to understand about crypto is that along with this idea of peer-to-peer transfer of assets and the fact that you don't need an intermediary, a bank, an exchange, somebody like that to allow these transactions to happen, that doesn't mean that's the reality of what crypto is. It is possible to have a world where all these transactions were happening without anybody in the middle, and this was just people sending complicated code back and forth to each other. But that is not the world that crypto has actually evolved into. A little bit ironically, crypto is much more concentrated. The power in the space, the entities that operate in the space, they're far more concentrated than they are even now in the traditional financial system. So what I mean by that is there are far fewer holders of total crypto assets with a lot more control over the marketplace in the crypto ecosystem than there are in the traditional financial system. Firms that operate inside the crypto ecosystem, that offer products and services to consumers, they often take the business lines of a securities exchange and a broker dealer and a bank custodian and a clearinghouse and a lender. They take all of those business lines and rather than have them separated into different companies, rather than having the traditional line drawing between conflicts of interests and separation of those businesses that we typically see in the traditional financial system, those don't exist. And so the platforms that have become the intermediaries, that have become the banks and exchanges of the crypto world, are actually much larger and much more concentrated than even those that we have in the traditional financial system. And that becomes another source of risk to consumers, both because, as we saw with the FTX failure, when you have that kind of concentrated control over this one set of assets, fraud or abuse, or even just mismanagement of a company can have profound impacts way beyond the clients of that particular company. The failure of FTX didn't just hurt FTX customers. It did great harm to anybody that had decided to take on exposure to the crypto ecosystem. That FTX model, where you had one entity providing all of these services, and very concerningly, offering up an exchange for its customers while also trading on its own exchange under rules that it had advantages over its customers with, it wasn't setting up a fair playing field. And so even in a world where Sam Bankman-Fried wasn't doing an enormous amount of fraud, investors in crypto often aren't getting the fair treatment that they think they would be because we have done, at least to some degree in our other marketplaces, providing transparency and fair rules, and we have regulators enforcing those rules. Um, that space looked pretty challenging when I was at the SEC, and we were aggressively trying to enforce financial regulations. Under the new administration, everything has gotten much worse. And there's a pretty clear signal from the current administration that there's no expectation that these companies follow the law, that these companies honor their commitments to consumers and investors. And so the marketplace is getting even more challenging and even more dangerous to, ordinary Americans who quite rightfully might have some suspicions around traditional financial markets who, as we all know, all having lived through 2008, have enormous weaknesses and unfairnesses built into them. Um, and they might see crypto as sort of an alternative to the problems they have, seen in that system. But the fact of the matter is crypto has evolved into this place that looks a lot like our traditional financial system, but does not have any of the regulations or any of the protections that we took decades to establish. And so those are the things that it's really important to be communicating to people. I obviously have very strong feelings about crypto and its utility. Um, I'm not sure that the right approach with people is always talking about whether or not there's anything standing behind Bitcoin or whether or not there's sort of any reason to believe that any of these electronic, tokens, this monopoly money is worth anything. Um, I think you can sort of remain agnostic on that point and still be really clear with people about what they're actually getting into when they get into the crypto space. Because it's unavoidable and everyone always wants to hear about it, I'll talk about the technology itself really briefly. Um, but again, before I do that, I just want to amplify and repeat that it's really important not to get caught up in the technological details. Um, I would compare this again to something we saw in the 2008 crisis, which is when people saw the absurdity of products like credit default swaps and all of these wild, crazy derivatives that were really hard to understand, Wall Street would come in and tell us all the time, well, yeah, we know it looks that way, but it's just because you don't understand the technology, you don't understand the innovations, you're not smart enough to understand what's going on, so you can't regulate this and you shouldn't have opinions on it. A lot of that happens in crypto as well, and there is no reason to be intimidated by this technology. There's no reason to let the technology drive the conversation any more than if you were talking to somebody about a payday loan, it would be important for you to discuss the types of the types of computer software that a payday lending company was using to keep track of their payment system. The technology is distinct from the economic product being sold here. That technology is often called the blockchain, or you may have heard it called a distributed digital ledger. The idea behind this technology is a lot like something you might be familiar with, like a Google spreadsheet, right? Which is to have a document that many people can edit at the same time, uh, so that you have a very transparent view of what's going on, what changes are being made, and using that as a way to track financial transactions. Now, you can imagine if you set up a distributed digital ledger and those transactions on a Google spreadsheet, a lot of bad actors would say, oh, I'm just going to put in this entry that I have 100 million Bitcoin. And now I can spend that 100 million Bitcoin in any way that I want. Immediately, that idea of a financial marketplace falls apart. So you have to have some way for everybody who can edit that Google document to agree on the edits that go into place. And one of the ideas behind crypto is there shouldn't be one single person who gets to decide which transactions go in the spreadsheet and which transactions don't. And so the idea behind crypto, again, is removing trust, removing reliance on some intermediary who has ultimate control over what transactions do and don't happen. So just as a Visa and MasterCard or your bank, unilaterally keeps track of the deposits and the debits to your checking account. That is done in the same way on this digital ledger, but you don't have a bank unilaterally deciding. You have all the people participating in the network coming to consensus about which transactions are valid and which transactions aren't. Now, there are a lot of ways to come to consensus among all these people who are working on this shared ledger. And the crypto ecosystem uses lots of them. I'll explain the simplest one, which is called proof of work. But there are lots of sort of variations on this theme that have spread out among the crypto world. They all function a little bit differently, but they also all do the same thing. And so proof of work is essentially what most of us think about when we think about crypto itself, when we think about Bitcoin, which is this idea that there's a whole bunch of computers running nonstop to solve these math problems and winning a Bitcoin once they have, solved a magic problem, eating up all this energy, making all this heat, contributing to climate change. That's the proof of work system that we're talking about. And the way that that system works is essentially it says, we're going to allow everybody who wants to transact in Bitcoin to run a validation node. They call it mining. But essentially, it is to allow your computer to connect directly to that Bitcoin network. Anybody can do it, anyone in the world. And you can be one of the people who tries to validate these transactions by having your computer essentially run a program that does a very complex guess and check computation. And essentially, that guess and check process is so random that anybody on the network has the same chance of finding it based on the amount of computing power they have. And so if I have one computer and my friend has 50 computers and we're both on that network, he is 50 times more likely to win this race guessing this random number. And if he does guess that random number, the rest of the network can easily verify that he's guessed the correct number. So this math problem is you essentially performing this guess and check problem that's very hard to solve, but very easy to validate. And so the way that the network works is that even though any one person can submit what they consider to be a solution to this math problem, which is what would allow the next set of transactions to go through, it takes the rest of the network, at least 51% of the rest of that network, to look at that answer and say, yes, this is valid, and therefore all the transactions that this miner or this validator proposed go into the next block, that go into our spreadsheet, are valid. And so that process happens over and over and over with every batch of transactions that needs to go through. And so again, rather than having one specific actor saying, here's what is a valid way to edit this spreadsheet, you have an entire network that has to work together in order to agree that these transactions took place and to prevent people from taking advantage of the network and spending their money in more than one place or claiming they have more money in their account than they do. That is called a consensus mechanism. And that consensus mechanism process is what allows for peer-to-peer transactions to happen in a way that no one can take advantage of. But again, the underlying technology, which is essentially having a spreadsheet that multiple people can edit or contribute to, has been around for years and years. And so when we talk about the crypto technology, distributed ledgers, you'll hear a lot. They are not unique to crypto. They are something that crypto uses as part of this broader process. And there are a lot of traditional companies that already use distributed ledgers in the traditional financial space. And so there's nothing about a distributed ledger that makes crypto unique. It is the way they use it that makes crypto unique. But even then, it is just a slightly different way of completing these transactions um, that makes it different from things we have already seen. Now, even though in a perfect, in an ideal crypto world, that would be the only way that these transactions happened, right? Is you would have every transaction come to this network, everyone would agree on those transactions, and then they would get processed. What has actually happened is crypto has found that to be very inefficient. It takes a whole lot of people logging onto the network. It takes a whole lot of resources, as we've mentioned. Um, you don't really get anything from solving this math problem. The whole reason to apply all this computing power doesn't really, it's not being used to run a network. It's not being used to, help study the human genome. It's not being used to transmit data. It's simply being used as a method to make sure not any individual person can update the blockchain or update this spreadsheet. And so all of that wasted energy and time and effort is a real cost to the crypto ecosystem. And so what they have done is, again, centralize this into a lot of platforms. Coinbase is a large one. You may have heard of Kraken. You may have heard of Binance. And they perform their work. Those companies perform their work the exact same way every traditional bank and every traditional stock exchange does, which is they run their own digital ledger, their own digital account of transactions, and they rely on that entirely for all the transactions between their customers. So what that means is the vast majority of crypto isn't using this technology I just described in order to facilitate these transactions. The vast majority of crypto transactions are happening on these centralized exchanges that do all of the exact same functions that a bank or other traditional financial firm does. They do it without using this technology that they claim to be, so important to their ecosystem. And they do it this way because just like in the real financial world, it's much more efficient not to use this blockchain technology. And so thematically, this challenge between the efficiency of this new technology and um, the realities of working in a large financial system like we have today is what is leading to this push from the crypto ecosystem to lower the regulatory standards for people who claim to be using this technology for their financial services products. The shorter way of saying that is because crypto was designed for exactly one thing, which are these very simple peer-to-peer transactions between two people. Once you try to scale that into the kind of modern financial system we have today, it needs a whole lot of regulatory favors in order to be truly competitive. And so, one of the reasons we're seeing this push to have special regulations around crypto is because if they had to comply with EFTA, if they had to comply with TILA, if they had to comply with the bank regulations with regard to capital or custodian regulations, if they had to comply with securities laws, these companies would not be profitable. And so, much like the arguments we used to hear back in the day, where banks would say, well, if you enforce these regulations, we won't be able to sell these products. Um, you have that same sort of thing going on where the excuse for deregulation is the desire to supposedly give people something that is useful and beneficial to them. Um, but as we have seen in the past, typically if someone comes along and says, I need I need exemption from regulation in order to offer my benefit to the consumers I'm trying to serve, there's probably something else going on. And so it's important to sort of keep that interaction with the regulators and the broader crypto ecosystem in the back of your head as you're advising folks about sort of how they should look at this space and what they're worried about, or how much they should commit and trust into this space. Um, So hopefully that sort of gets you your head around enough about the technology itself, um, while also, making sure that you never put yourself in a situation where you're being forced to have a debate about technology rather than about the suitability of any kind of credit product or any kind of financial product or financial service provided to consumers, just like we've seen, over the past 100 years. Um, One of the other things we wanted to touch on is because of this, peer-to-peer system and because of the anonymity we talked about earlier, um, it is also a space where it is really easy to both commit fraud and also get away with fraud in a way that consumers can never see recovery. We have seen crypto grow as the number one vector of pig butchering scams, not just in the United States, but globally. The FBI put out studies on this last year. It's grown by 63% this year over last year. And it's tens of billions of dollars that have been unrecoverable from consumers that have been, in large part, roped in by romance scams, many of which you are probably already familiar with. But sort of the long and short of it is, a person reaches out to you by email or text messages and says, oh, I ran into you accidentally. How interesting is that? Let's start up a conversation. That conversation creates a relationship. The person who's being scammed starts to believe that they have some kind of personal connection to the scammer that they are talking to. And at some point, the scammer will say, "Hey, I need you to help me out. I need you to send me money because I'm in trouble." Or they will say, "Hey, I have this great investment opportunity for you. Um, you should talk to this person I know who can help you, double, triple your money." And because they've built that trust, they can convince someone to move their investments or move their cash into crypto. They can convince someone to transfer that crypto. And the nature of crypto, when it's not being handled by an intermediary like Coinbase or one of these big platforms that functions like a bank, when it's working in that just peer-to-peer system, those transactions are anonymous and they cannot be reversed. So once a scammer gets your money, they may not be able to be identified at all. And there's no one who has the power to reimburse that money. So we are seeing this happen with the proliferation of crypto ATMs that are being put up, where people will be told to go take their cash and put that into ATMs, turn it into crypto so that crypto can be transferred to these bad actors. And the scamming money that is being pulled out of these communities is also closely related to an enormous amount of fentanyl trafficking, money laundering for drug cartels, um, the uh, trafficking in explicit child images, kind of all of the worst things you can think about in terms of black markets are all funded in part by this scamming of consumers. And so we have sort of just not just the harm to the individuals that is happening here, but broader harm to the community um, when all this fraud is going unpoliced and sort of can't be tracked and can't be turned around. And so I think that is important for people to understand because while everyone always needs to be on the lookout for financial scams, traditionally there has been some amount of recourse available. Um, there has been a duty on a bank or a credit card issuer to deal with fraud, to look for fraud in advance, to provide those protections. And very few, if any, of those protections, and very few, if any, of the tools we used to use to chase down illegal transactions and find the culprits are available to us in this space. So not only does a consumer need to be as careful and as thoughtful about any kind of investment or purchase they would make in the financial markets, they need to be even more on guard in this space because there are fewer protections underlying any of those transactions and any of those opportunities. One last thing I wanted to touch on that's sort of a specific subset of the crypto ecosystem that, especially because of recent legislation, I'm sure a lot of folks have heard about, and that is stablecoins. And so a stablecoin is a very particular type of crypto asset that rather than something like Bitcoin, which as we've seen, the price, flies up and down and is very volatile, a stablecoin is designed to keep a stable price. Um, Typically, they're pegged to the dollar. And the way they are created is that a company essentially buys up a bunch of safe financial assets like treasuries or other securities investments, AAA securities investments, and then issues tokens um, consistent with the amount of assets they have. So ideally, they'll have $1 in securities for every dollar they issue in their stablecoin. And the reason for these stablecoins is to allow people to transact in crypto markets because you can't really trade physical cash or use your debit card on a blockchain. And so you need these stablecoins in order to interact with the crypto ecosystem. And that's why they were invented. But now they have been seen as a way to make payments more efficient in the regular financial system. Um, I think you can have a debate about whether or not the technology actually makes things more efficient, and I don't believe it does. But what is really consequential about stablecoins is that they are sold as functioning like cash, like a deposit, when in fact they don't have FDIC insurance. They are not backed like dollars by the full faith and credit of the United States government. Um, they are not like a bank deposit where you receive interest for depositing that money or holding that deposit. And finally, explicitly because of the legislation, there are a lot of state and federal consumer protections that don't apply to stablecoins in the way that they would apply to any other payment mechanism. And that's important not just because people are getting more and more exposed to crypto and stablecoins, but because we're also seeing the traditional financial firms start to move their business to the stablecoin space because it's less regulated and there are fewer compliance burdens. So it's cheaper to operate in. So, as an example, you have Visa and MasterCard, the large payments incumbents, have started to say that they're getting involved in the stablecoin industry. And what I think is likely to happen there is that even though customers will be sort of interfacing with their credit card and the payment system in the same way they always have, there will be a small amount of fine print updated in their credit card at some point that says, when you use this credit card, what you're actually doing is a stablecoin transaction. And stablecoin transactions are subject to a new law and new regulations. They are not the same as your old credit card payments were. You don't have these protections anymore. And a lot of consumers aren't going to realize that because the standards have been lowered for one part of the payments market, they've been lowered for everybody. Um, and so, again, I think the important thing to take away from all of this is that aside from the hype, aside from all of the sort of like dazzling technology arguments, aside from all the complication and overpromising, it is really important to maintain a level head about this and to carefully evaluate any product, whether it's Bitcoin or Ethereum, whether it's a lending product, whether it's an opportunity to deposit Bitcoin on a platform and make supposedly 10% APR interest. It's really important to evaluate all of those investments or choices the same way we would any other consumer product, because there's nothing about this technology that limits the kinds of risks we've seen in every other traditional financial space. And there are things about this technology that exposes consumers to new risks that have not been very well uh, explained to, disclosed to consumers who are getting into this space because they see, an opportunity to make money. And so hopefully that is all some sort of helpful context to lead into the conversation that Sharon will lead here about sort of how this is all affecting housing directly. And if we have time for it, I would love the opportunity to answer any questions.
We'll go ahead and let Sharon move forward, and we'll do the questions at the end. That was so much
Great.
information. And I just want to say, I put it in the chat, but thank you so much, Corey, for acknowledging that housing counselors saw that financial crisis of 2008 well before it happened. So thanks, and go ahead, Sharon.
Great. Yeah, thank you so much. We'll get to questions at the end. So if you have questions for me or for Corey, make sure to put it in the Q&A. I know it's a lot of information, so this is your opportunity to ask any question that you may have about crypto. Like Corey especially is like the right person to kind of answer any of your questions about it. I also want to say if you have any story, I saw one story by Sheila in the chat, but if you have any stories of what you've seen working with clients, we'd love to know it, and please share it, like what you've seen around crypto or the questions that clients have brought to you around crypto. It'd be really interesting to hear what you're seeing on the ground right now. So Corey is our crypto expert, but I'm our housing expert. So in this conversation, I'll kind of talk a little bit more about what you should know about crypto for housing and how it's starting to impact or not people's ability to get a mortgage. And to do that, I also offer a little bit more context on FHFA and what they are planning like around crypto. So the next slide. So this is what I'll be talking about today. I'll give you a little bit more context about what's going on at the Federal Housing Finance Agency and in general, but also what they're planning to do around crypto. So I'll talk about its directive that Bill Pulte, the head of FHFA, issued earlier this year on crypto. Then I'll talk a little bit about why it's a bad idea, why we don't think crypto for underwriting mortgages, especially mortgages supported by Fannie Mae and Freddie Mac, is a good idea. I'll talk a little bit about the crypto mortgages that currently exist. They're kind of niche products, but they do exist. And then I'll wrap it up by talking a little bit about what this means for housing counselors. But first, what is the Federal Housing Finance Agency? It's now also known by its new nickname, Federal Housing, coined by Bill Pulte, who is the head of FHFA. So FHFA is a top housing regulator in the country. So, when we're thinking about kind of federal agencies, HUD obviously is like one of the most important ones, but then FHFA kind of comes in second in its impact on housing. The role of FHFA is to oversee Fannie Mae, Freddie Mac, and the federal home loan banks. These are all kind of government-sponsored enterprises, so they're all these kind of big, institutions that kind of help regulate mortgages in particular and our housing market. And Fannie Mae and Freddie Mac in particular, they together hold and securitize, around 59% of all mortgages in the United States. So they have a massive impact on the mortgage market. So whatever FHFA does or decides, or and whatever it sort of dictates of Fannie and Freddie, can really shape the kind of mortgages that we even have and that consumers have access to. So in the next slide, so as I said, President Trump appointed Bill Pulte to be the lead of FHFA. So he is sort of our key housing regulator. And it's important to understand that he actually has a lot of power because FHFA right now is not only the regulator of Fannie Mae and Freddie Mac, but it is also the conservator. So as you all know, 2008 didn't go great for mortgages in the United States. Over 10 million homeowners across the United States lost their homes because of, mainly, subprime mortgages that were being sold to consumers and mortgages that they couldn't afford to repay. So these faulty mortgages were also dragging down Fannie Mae and Freddie Mac, and both Fannie and Freddie were at risk of going bankrupt. So at the time, the government stepped in and Treasury, spilled out Fannie and Freddie. So as of today, we as U.S. taxpayers still kind of own Fannie Mae and Freddie Mac. We hold the majority stake in Fannie and Freddie. So like 79.9% of all kind of stock is owned by US taxpayers, basically, right? So this means that Bill Pulte at FHFA, has a lot of power. He also acts on behalf of taxpayers to kind of oversee Fannie and Freddie. So there's a lot of power that he has there. Um, and while FHFA has had this power since 2008, we see that under Bill Pulte, he's really taking that power to heart, and he's really, leveraging FHFA in all kinds of new ways to basically execute Trump's political agenda. So the next slide, I'm kind of giving a little bit more context on that. So Bill Pulte's nickname is also Mini Trump. But what we are seeing is that he more and more has been using FHFA as sort of a tool for Trump's both populist and sort of more political agenda. So here's just an overview of what we've seen over the last year, mainly at Fannie Mae and Freddie Mac, which has really been his focus. So we've seen upheaval at the boards, the independent boards of these GSEs. Bill Pulte appointed himself as the president of both boards and sort of stocked the boards with people he knew were loyal to him. We've seen widespread firings at not only FHFA, but also Fannie Mae and Freddie Mac, especially, anyone who sort of worked in a more pro-consumer space, mission-based work, research economists, and then, of course, also the Fair Housing Division has been severely cut in all these three places. Again, sort of consistent with sort of a Trump agenda. You may have seen this in news, but Bill Pulte has directed employees at Fannie Mae to look at the mortgage documentation of specific political enemies of Donald Trump to try to kind of go after Trump's political enemies by alleging mortgage fraud. So Adam Schiff, for example, is one of the targets. If you're on Twitter, you may have seen Bill Pulte tweet a lot about Jeremy Powell and, really trying to get Jeremy Powell to lower interest rates, and sort of he even wrote a draft resignation letter for Jeremy Powell that he gave to Trump. So there's kind of Twitter wars going on around the Federal Reserve Board, which traditionally, of course, is not the job of the FHFA director, right? The job is to make sure that Fannie Mae and Freddie Mae and Freddie Mac work well and are safe and sound. And then this happened just 2 weeks ago. Bill Pulte kind of came up with this 50-year mortgage idea as a way to try to improve affordability. But I think as housing counselors, like, you understand that just extending the mortgage even longer and is not may lower monthly payments a little bit each month for people, but the result will be that people will pay hundreds of thousands of dollars more in interest over a 50-year term, right? So it's not a good idea. And I haven't seen, I don't think I saw a single defender of this idea in the industry or in the advocacy space. Everyone sort of came out united that this was a terrible idea. And I don't have it on here, but another topic that Bill Pulte has really been pushing for is this question of the release of Fannie Mae and Freddie Mac out from taxpayer control. So that's another discussion that he has been having. But on the next slide, the question of crypto in mortgage is part of these kind of more kind of populist pushes by Bill Pulte to try to appeal to Donald Trump and the sort of Trump political agenda. So in June of this year, you can see a little screenshot on the left. Bill Pulte tweeted the following, and this was like the way that this was announced. He tweeted out this directive, and I have it on the right. You can see a direct quote. He was urging Fannie Mae and Freddie Mac to prepare a proposal for the consideration of cryptocurrency as an asset for reserves in their respective single-family mortgage loan risk assessments, without conversion of said cryptocurrency to US dollars. So what this means is he's asking Fannie Mae and Freddie Mac to look at their underwriting standards to see if they can allow people to use crypto currencies that they hold for mortgage underwriting, right? For their ability to get a mortgage without them having to convert cryptocurrencies into cash. So to kind of, value cryptocurrencies just for, that they're holding, and to not require people to convert them into cash in order to, for example, use them for a down payment or kind of show that they have stable assets. So that's what happened in June. But it's a directive. So on the next slide, this is so far it's been policy making by tweet. There is very little specificity. So it's a directive that he gave to the leadership of Fannie Mae and Freddie Mac. So we're waiting to see what Fannie and Freddie are doing. They haven't come up with a final policy yet. And this is not a rulemaking, so there's no opportunity. There has been no opportunity for public input. So in the next slide, so together with the National Consumer Law Center, we at the Consumer Federation of America wrote a letter expressing serious concern about this directive and this sort of move to start allowing crypto in mortgage underwriting for Fannie and Freddie backed mortgages, right? For conventional mortgages. So we wrote this letter, and we also have been engaged in conversations with the media to kind of raise awareness around this issue. So why is it a bad idea? On the next slide, I kind of give a quick overview of 4 key reasons why it's not a good idea. And the first one, and Corey already spoke at more length on this issue, is that cryptocurrencies have a lot of volatility. Just this last week, Bitcoin saw a steep drop, and it's now 30% down from its peak, right? If you look at if you compare the performance of stocks to Bitcoin over the last year, if you look at graphs, like Bitcoin is up and down, like very steep peaks and bottoming out. But so it's very volatile. So it makes it really difficult for mortgage underwriting, right? Because what is it worth? It may be worth something different tomorrow than it is today. In addition, as Corey also highlighted, there's a lot of non-compliance, kind of trying to evade regulation in crypto markets, which make them very susceptible for fraud, right? So it's another kind of, do we really want to build, Fannie and Freddie now on the sort of potential house of cards of crypto coins and the crypto industry? It's something that we've all seen before. So what foundation do we actually have when we start to build mortgages on this kind of unstable asset? The second, as I said, Fannie Mae and Freddie Mac are right now actually owned by taxpayers, right? But even after release, which is also called privatization, even if we kind of come up with a solution for them to exit conservatorship, they are still backed by taxpayers. The lessons from 2008 kind of showed that Fannie Mae and Freddie Mac are basically too big to fail, right? They constitute a really important part of the U.S. economy. So it's not that we as taxpayers can say, well, let them fail, we'll move on. It's just too essential to our economy. So that means that even outside of conservatorship, they remain what's called, these GSEs, government-sponsored enterprises. So they're remain backed by taxpayers. So it's not a risk. You could make an argument for, private companies kind of wanting to take on this risk for themselves, for mortgage underwriting. That's one argument, but this risk definitely does not belong in, the GSEs, which are also more focused on supporting kind of a safe and affordable mortgage infrastructure for everyone, right? So they're not there to support crypto millionaires wanting to buy their homes without having to cash out on their crypto. Third, and I think Corey may have kind of gestured towards this too, we worry that with, this directive by Bill Pulte and FHFA, there's kind of a misplaced mainstreaming of these cryptocurrencies. It gives a wrong message to consumers that, if they can use this for mortgage underwriting, if they can use it for buying a house, that somehow they're safe and that they are, they have a stamp of approval from lenders and the government, right? So uh, these remain very risky, underregulated assets, right? So there's kind of a misplaced mainstreaming if Fannie and Freddie kind of come up with ways to use crypto coins in mortgage underwriting. And then finally, you know, the risk that is posed to the most vulnerable consumers, right? Like we've been here before in terms of, accepting predatory products for Fannie and Freddie securitization. Um, and we know that at the time in the 2000s, there was a real push by lenders to kind of keep expanding the credit box so they could keep having kind of business come through the door. And I worry that, with this push for crypto and the sort of mainstreaming, that the target again will really again be the most vulnerable consumers, many of the consumers that you work with directly that come in your door, right? That have maybe um, misplaced ideas about crypto as a quick way to get wealthy, to kind of get into home ownership. So I think the risk of mainstreaming these products and saying, oh, you can use it for mortgage underwriting in Fannie and Freddie mortgages, like is ultimately the risk to these most vulnerable consumers, right? Which will be hardest hit by this type of predatory outreach. So in the next slide, these are all key reasons why, we don't think that Fannie Mae and Freddie Mac should support mortgage underwriting, that uses crypto directly, right? We don't think it has a place in the sort of mainstream um, mortgage landscape, and it shouldn't kind of become a foundation of our whole mortgage system and our housing finance system. However, it doesn't mean that crypto mortgages don't exist. Like there are these crypto mortgages that are out there, and I think for as far as I could find, it seems that back in 2018 in Seattle, saw one of the first crypto sales of a home that involved a mortgage, where a buyer, ultimately liquidated his crypto holdings to kind of buy that house with a mortgage. Um, but like we're seeing more and more, we're seeing these kind of innovative, small lenders, I guess, kind of pop up trying to offer these crypto mortgages. So what are they? So they are non-qualified mortgages, right? So they are, it's known as non-QM. So they are not part of kind of the Dodd-Frank regulation around like ability to pay, and all of that. They kind of exist outside of that space. Like, so they're purely in the private market. They have nothing to do with Fannie Mae, Freddie Mac, or FHA, right? They're kind of these specialized products. They seem to be mostly targeted at wealthy consumers that may hold a lot of crypto, and either don't have the W-2, don't have the income to show for the size of the mortgage that they want, or they want like they want to buy an even bigger house based on their crypto wealth, but they don't want to liquidate their crypto. Why don't they want to liquidate their crypto, right? They could just convert it into cash and buy a house. Well, they want to avoid capital gains tax, right? So, they want to avoid paying those tax liabilities. And some of them, they believe that by staying invested in crypto will just keep going up and up and up, and can provide them more wealth in the future. So these loans have much higher interest than the mortgage that you and I are most familiar with. Oftentimes they're interest only. So for example, for the first 10 years, the borrower would only pay interest on the loan, so would not actually pay off the principal, right? So there's kind of a like kind of balloon element to it, where later on the principal is being attached to it, and by only paying interest for the first 10 years, they also end up paying a lot more interest overall. And they often rely on 100% or more of kind of crypto collateral. Let's say you buy a house for $400,000. With this kind of mortgage, you'd have to show $400,000 worth of Bitcoin, for example, to kind of put up as collateral. But the house will also be the collateral, right? So let's say you put up $400,000 in Bitcoin, last year, and now all of a sudden it's worth 30% less. you'd have to either come up with more, or you risk losing your house as collateral too, right? So this is pretty tricky. And they are niche products. So these are generally not the products that the clients that you work with like would qualify for. These are generally for mansions, not starter homes, right? For people that are that are heavily invested in crypto, and are seeking this sort of specialized product. So, they do exist. They are niche, but this is very different than kind of legitimizing crypto as part of like, Fannie Mae and Freddie Mac, or even, FHA, right? This is like a very different niche small market. So in the next slide, some takeaways. I hope I gave you a little bit more context. So Fannie Mae and Freddie Mac have not finalized their proposal yet in answer to the directive of Bill Pulte. So this means that right now, home buyers cannot use crypto for conventional, for VA, USDA, or FHA mortgages. If they want to use crypto for those mortgages, they'll have to convert it into cash in order to use the value of this asset for mortgage underwriting. So it's not a reality yet. There is this thing of that's called crypto mortgages, but right now they are a very niche product. They're a non-QM type of mortgage that are generally geared towards like higher wealth kind of niche buyers, as is most of the non-QM market is kind of geared towards these like specialized, usually wealthy buyers. So you, as housing counselors, and I think this goes back to what Corey was saying too about housing counselors already knowing in the early 2000s that the 2008 crash was on the horizon, kind of seeing the writing on the wall. Please, please watch what you're seeing. Tell us what you're seeing. If you're seeing emerging kind of predatory practices, fraud, kind of misinformation about crypto among your clients, it will be very important to sort of raise the alarm bells, alert the National Housing Resource Center or groups such as CFA, Corey and myself, as well as NCLC, which is another like national group that's really focused on these issues. So we do rely on you partly for kind of your ears on the ground to see how consumers are kind of interacting with these crypto assets, how they're investing in it, what misinformation is out there, basically, and whether you're seeing, vulnerable consumers, kind of over investing or being overconfident in these kind of crypto investments. And then finally, I think this raises important issues like around, the financial education that you're giving both one-on-one, but then also in classes, right? Like I think it's time to, if you haven't done already, to kind of include crypto, a little bit of crypto in the curriculum so people are aware and give them sort of sober perspective on, the place that it has and doesn't have in both wealth building and kind of moving towards home ownership. Scory said too, like this is like a high risk, investment that may not be the right one for someone who's working towards first time home ownership, right? And is doesn't have a lot of other assets to fall back on. So on that, thank you so much. I have a final slide that just has some links. So if you want to read more, you can read our letter that we sent to FHFA, as well as an American Prospect article, like that's all about crypto in mortgage. And looking forward to reading your stories and hearing your questions.
Thanks, Sharon. I am pasting those links into the chat along with yours and Corey's contact information. And we have a lot of questions. So buckle up. Here we go. Okay. So how does it play in the current financial world as legal tender for services provided? I ask because the dollar is based off gold. However, what is crypto based off of?
I think in sort of legal tender is a little bit outside of my expertise, but I will say that It is not. I mean, you generally speaking, some of this is changing. Like you can't pay your taxes with it. It is not legal tender in the vast majority of nations. It was for a short amount of time in Venezuela, and they have actually reversed that decision. And in most large economies, not only is it not legal tender, but it has generally been banned entirely. So it is illegal to privately own crypto in China. In Russia, it was illegal to own crypto. Last year, they changed the law to allow for crypto to be used in international transactions. And the Russian foreign minister said essentially that they did that because it would be helpful getting around Ukraine sanctions. Um, and in the EU, they were for a long time sort of following the US's lead on this. Um, and they typically have been pursuing through the European Central Bank, the ECB, what's called a central bank digital currency. In other words, crypto that would be issued by the government itself and function the exact same as cash. Um, and so different kinds of crypto are based on different things. Stablecoins, for example, are based on the reserves of real world assets that a company is holding. Um, Things like Bitcoin and Ethereum are often based off of sentiment or a belief in how the technology might be used in the future.
Okay. Let's see. My understanding is some use AI to help with crypto decisions. Just wondering about your thoughts. Have you heard this?
So I mean, I think people are using AI to make all kinds of financial decisions. There has been some talk, and I am not an expert on agentic AI, as we have some folks at CFA are. But essentially, there are AI platforms that may essentially make purchasing decisions for you based on parameters that you give them. Crypto may be a useful way for them to be able to automatically, spend money on any of those goods and services that might be chosen by the AI. That is the extent of my knowledge on that subject.
Okay. Um, the National Cryptocurrency Association is a platform to help you understand what crypto is and how it works. They have short videos and a great podcast. As housing counseling agencies, we cannot give our clients financial advice about whether or not to invest in crypto or what to do if they get scammed. At this stage, providing resources where they can educate themselves is the extent of what we can do. And I'll pop that
Mm.
link into the chat in case others want to access it. So, not really a question, just somebody sharing. Thank you.
If I could say briefly, I do think
Sure.
it's really important to get your information from lots of different sources. I know, that particular source, a lot of industry is involved in that, and obviously, I have a perspective, industry has a perspective, regulators have a perspective. It is really important to sort of get all of the information from different sides and use that to help evaluate all of the decisions the way you would with any other financial transaction or any other financial asset.
Thank you.
Mm.
Well, and along those lines, is crypto really considered an asset? And if so, in what form?
I mean, I think there's general agreement among everyone that crypto assets are themselves assets. There has been a question raised about what type of asset that they are, whether or not they're a security in certain instances, or I should say whether or not they're often sold as a security. There is legislation in Congress that has sort of seeks to change the analysis, the securities law analysis that crypto would undergo as compared to other traditional financial services. Um, but yes, it is an asset. It can be traded as a financial asset. It is, pooled into certain. So, like Bitcoin, for example, there's a general agreement that it is not a security. It has been pooled into investment vehicles like exchange traded funds, which are sort of very widely distributed to retail investors and ways to gain exposure to crypto and those crypto assets through an SEC regulated kind of package that is an alternative to sort of buying crypto assets directly. But when it comes to financial regulators, when it comes to the IRS and taxes, there is broad agreement that crypto assets are assets.
So, and along those asset lines, then how does a client document the asset to satisfy an underwriter?
I think that's going to be a really challenging set of questions that we may not have delved into yet. One of the things about crypto that is challenging is that when it comes to something, for example, like escrow, um, the uh, the the steps you need to take to make sure crypto can't be transferred or taken out of possession of either the bank custodian holding things in escrow or the buyer or the seller. Um, that all requires a lot of technology that many financial institutions haven't really had enough experience with to make dependable and safe. And so part of this is going to be about hopefully regulators, if the decision is that, for example, crypto should be part of the underwriting process here, um, setting standards for how you would make sure that's under control. Um, Anyone with what's called a private key to a crypto wallet can move those funds around. And like I said before, those funds, once moved, are often irrecoverable. And
Mhm.
so some of those challenges of the new technology may require additional investments in technology and education for the service providers themselves and additional government regulation to make sure that funds stay where they're expected to be.
Okay. And somebody wants to know, Corey, if you have invested in any crypto yourself.
I have not invested in crypto, and this is a point at which I will, and hopefully my comments so far have been balanced and neutral. But I will say I view crypto not as an investment, but as speculation. People have the right to speculate, but I do not evaluate any crypto that I've seen so far as the kind of investment I would consider or, for example, recommend to a retirement saver. So that's why I don't have any.
So, any success stories with crypto that you're aware of, anyway?
Maybe in the
I mean,
chat.
yeah. Yeah, maybe the chat will have some success stories. Look, people have gotten rich off crypto. There's no denying that. People have gotten rich in the financial markets. There's no denying that. So certainly there are success stories. Um, I mean, I would point to as a for example, again, always going back to the 2008 crisis, which kind of shapes all the work I do. Um, there were people who made a lot of money off that crash. The Big Short is about some people who profited hugely. Um, I don't think I would describe that necessarily as success. And so when we talk about success stories with crypto, I would want to see sort of adoption of the technology in ways that, for example, actually lowered costs to consumers um, or heightened protections for consumers, while also providing additional wealth. Generally speaking, people who have bought Bitcoin over the years have lost money. Um, and that is a function of the price of Bitcoin, going up and down with a great amount of volatility. Um, and so, there are success stories, but just as with any other financial instrument, risk is always commensurate with reward. There is no way getting around the financial fact that if you want a really high return, you are likely taking on a really high risk. And so there's nothing magic about crypto that protects it from the downsides that also show up as its large upsides.
Mhm.
Okay, I do want to say one person did point out that as housing counselors, we can't absolutely advise around what clients can do if they're scammed. This could be through referral to law enforcement, FTC, or local national consumer protection agencies without infringing on any regulations we have in giving investment advice. Just because a scam happens with an investing tool doesn't mean we can't support in doing something about it. It's a very good point. Thank you. Okay, I thought privatization of Fannie and Freddie was already underway.
Well, I was at a meeting the other day, and someone brought like an 8 ball, to sort of talk about what's going to happen with Fannie Mae and Freddie Mac, and she just kind of shook it, and that's where we are at. It's not underway. It's not underway yet. There's a lot of conversations happening both at Treasury and separate conversations happening at FHFA to think about the future for Fannie Mae and Freddie Mac. What I think, or what is sort of projected to happen early next year, is that Bill Pulte is planning to do an IPO offering to kind of sell off 5% of the value of the stock that we as taxpayers hold, to kind of see, if they can raise money for the federal government, basically, in what they're hoping to be the largest IPO in U.S. history. That's kind of like the goal. It is expected that if that happens, like a lot of the buyers of this stock will be maybe foreign governments or other big companies that are seeking an in with the Trump administration. So that's sort of more imminent. I think Treasury is talking about like a long-term strategy for releasing Fannie Mae and Freddie Mac, but it's not that simple. But I mean, they've been talking about this for 15 years, but I think we are getting closer. But I don't expect it to happen anytime soon. I don't think that's like this. Maybe in the next 3-4 years. But everything I've heard is that it's still going to be a long process. Yeah.
Okay. How do the mortgage companies monitor the collateral for crypto mortgage?
I think just Corey explained that a little bit, that it's very difficult to make sure that the collateral put up for a loan like this will stay in place throughout the loan, right? And then especially because its value also fluctuates heavily. And I think this is why what we've seen so far are these very niche specific mortgage products that are in some ways very over collateralized, right? So it's like you not only need 100% of your loan in equivalent Bitcoin value, but then also the house is an additional collateral for the loan, right? So there's a lot of um, collateral, considering, I mean, lenders they understand that this is risky for them too, right? So, the collateral and then the higher interest rate and the fact that it's interest only reflects the risk that they're perceiving in these types of transactions too. So, but yeah.
Okay. Okay. So this is kind of a amusing, not musing, not one word, two words. This is a housing counselor musing. Okay.
Mhm, mhm.
Uh, so this housing counselor wonders if we as housing counselors should count crypto as buyer assets. So if someone wants assistance and shows they have the amount needed in a traditional bank, but has like 200K in crypto, how
Mm,
should we account for that information?
yeah. I don't know, Corey, do you thoughts on that?
I mean, I think that's one of the things that, to some degree, if I understand the underwriting considerations at Fannie and Freddie being considered right now, is sort of like one of the things they're trying to think about, right? Which is how do you value this stuff? Um, what are the appropriate ways to allocate it with regard to the collateral? And what what role should it play in an underwriting decision? Um, I'm not sure that I have, answers to any of that. Um, I always go back to with crypto again is to make sure we're looking at it the way we would any other financial asset. Um, there are certain types of securities holdings that would not be considered to be part of the underwriting process or part of the assets available to a person, and where if you wanted to use those assets, as I understand it, it would require you to sell those positions and turn them into an asset that could be considered for those kinds of things. And so, me personally, I look at certain private securities offerings and certain types of assets, potentially art, things of that nature. And I would
Mm,
evaluate crypto under those same terms of, is this deeply traded enough? Is it following a set of regulations? Is it dependable? And is it something that the parties can agree on, like will actually be transferred or will be available to support mortgage payments or collateral or anything of that nature. It just needs to go through the exact same analysis as any other asset. Um, Based on my understanding of the conservative approach we've typically taken with the kinds of assets that you would include in those kinds of valuations, I don't think there are any crypto assets that meet that standard yet.
Yeah, to that point too. In terms of the way that mortgage underwriting is already considering these other more like non-liquid assets, right? Not cash. Is that, what I think will happen is that Fannie and Freddie will release something, but will sort of say kind of, well, if to the extent that we value this, we have to apply steep haircuts to it, right? So like it doesn't count for the full value that Bitcoin happens to be traded for that day. It will count it, 20% of that total value at this point, right? Like kind of haircuts to sort of still somehow take it into consideration, but recognize the volatility and the risk and that is associated with this asset. That's the direction that I think Fannie and Freddie will go in order to kind of recognize this emerging asset while also recognizing some of the issues that we've raised so far. Yeah.
Okay. Are you seeing more cities or states banning crypto ATMs, and how can we help in this cause?
There aren't a lot of states or municipalities that I know of that are banning crypto ATMs outright. However, there is a big movement at the state level to provide regulations around ATMs, crypto ATMs, to make sure folks are better protected when using them. These typically revolve around disclosures, daily transaction limits, um, requirements for record keeping, receipts, the ability to reverse fraudulent transactions, um, a lot of things that we would sort of expect from similarly situated products. Um, AARP has been doing a lot of work in this space. If I'm remembering my numbers correctly, 14 states have passed crypto ATM legislation. Um, 20 states have considered bills to adopt that kind of legislation, and expect to be considering those bills in their next legislative sessions. And then another, like, I don't know, 10 or so have passed regulations, not legislation, but regulations addressing the issue. So the short answer is like there's been a lot of activity in that space. AARP has been spearheading a lot of that activity. Myself at CFA works on this quite a bit with AARP. There's another great group who is also a great resource with regard to enforcement or scams called Operation Shamrock, which is a nonprofit that has a lot of crypto experts and a lot of crypto enforcement people from around the country and brings them together to work on these issues. They are also big consultants when it comes to these ATM regulations and laws.
So if you have some kind of spreadsheet or list of like states and where they're at with it, if you could email that to me when we put the webinar recording out, we'll include it in the email that goes out. Because that I'm sure would be really helpful. And then people can contact their state level folks about their thoughts about the pending legislation. Okay, what is crypto mining and this talk about not very much crypto being available?
I used the term earlier, consensus mechanism, as sort of like the generic term for for all the different things, like different types of crypto use to determine which transactions are valid and not valid. And mining is a term that's pretty specific to Bitcoin. Um, and Bitcoin mining is that proof of work process I explained, where anybody can attach a computer to the network, and they sort of try to solve this very large, hard guess and check problem that is hard to solve but very easy to verify. And so mining is that activity. Um, there are lots of large organizations that have bought up very large sets of data centers. These are data centers that are not useful for AI. They're not useful for other work. They use a different kind of computing and CPU technology called ASICs, which you don't need to get in the details of, but um, all of that mining happens on these very specific machines in purpose-built facilities. And so that's a miner is someone who participates in that consensus mechanism, either one person doing it from home or a large corporation that does it through the use of these very large data centers. Um, the second part of that question was, I forget the second part of the question, but that's what mining is.
What's the deal with it? They're being
Right.
limited.
Yeah. Yeah. So, not all crypto is limited. Bitcoin specifically, there will only be a total of 21 million Bitcoins ever issued. After the 21 millionth is issued, no new Bitcoin will be available. New Bitcoin is created when one of the miners solves this complicated math problem. They are rewarded with Bitcoin issuance in order to sort of incentivize miners to put that work and energy and investment into running the Bitcoin network. And so, because one of the founding ideas of Bitcoin is to avoid inflation, they decided that only 21 million can ever be produced. That way, you can't print more and, in their mind, devalue the overall value of Bitcoin. And so, in that case, there is a limited number that will ever be printed unless somebody, unless they agree to change the network, as has happened before. Um, but that is what you're hearing about when you hear about the limited amount of crypto available.
Okay. Are there various forms of crypto other than Bitcoin and stablecoin?
There are about 15,000 crypto tokens available. Some of them are meme coins that I'm sure you've heard of. Some of them are similar to Bitcoin in that they are sort of like a native token on their own specific kind of blockchain that uses their own specific kind of consensus mechanism. Um, the very largest cryptocurrencies in the world are Bitcoin and Ethereum. They make up two-thirds of total crypto market assets. And that's been true throughout history. Typically, it's been about two-thirds Bitcoin and Ethereum, and then the rest of the ecosystem. And in the portion that is Bitcoin and Ethereum, two-thirds of that is Bitcoin. That is all to say, when you see um, reports that, Bitcoin is a 3.5 trillion market, or sorry, crypto is a 3.5 trillion market, or, the crypto market gained $300 billion today or lost $300 billion the other day. What you're typically seeing is the price of Bitcoin changing, and the rest of the market tends to follow that. So while there are a lot of different types of crypto, whether that's Bitcoin or Ethereum or some others include Solana or Arbitrum, um, uh, the market is generally driven by those two largest assets. And the other sort of big part of the space is the stable coins we talked about. That accounts for, if I'm remembering off the top of my head correctly, about 250 to 270 billion dollars of that marketplace. And so pretty far behind both Bitcoin and Ethereum, but sort of the next most significant part of the market. And the rest of that market is that's not Bitcoin, that's not Ethereum, and that is not a stable coin is typically called the altcoin market. There are also more pejorative terms for that market, but it tends to be less liquid, less well known, and to some degree a little bit less dependable than sort of the what you might consider the blue chip crypto of Bitcoin and Ethereum.
Okay, and our final question, is it considered a very high risk alternative financial option and just needs to be regulated in some way? This sounds to be another consumer beware issue. And I just kind of want to pile onto that a little bit to say, in this whole talk about speculation and that word being used, I just remember that word being used over and over again in relation to the initial financial crisis back in 2008, that speculation was what really was at the base of that. Um, so anyway, sorry, back to the question. It sounds like another consumer beware. And do we just really need to get it regulated?
So I was, for those who don't know, I was at the SEC. I worked for Chair Gensler and was our crypto advisor. We took the position while I was at the Securities and Exchange Commission that the vast majority of essentially non-Bitcoin crypto was being offered and sold as a security. In other words, not that it was unregulated, but that the market was not compliant with rules that already applied to it. So I tend to look at crypto as a space where again, setting aside Bitcoin and some things that are very similar to Bitcoin, the vast majority of the market should be uh, subject to the 33 Securities Act, the 34 Securities and Exchange Act, the 40 Act, the Investment Company Act. This regime we have built around securities that makes sure there is transparency and disclosure, that make sure there's a fair and orderly market for the platforms that allow for trading of these assets, just like they would with any other security. So I'm a proponent of applying current law. I think that is the exact same truth for payment stablecoins. Just like any other electronic payment that we have encountered before, they should be subject to the exact same regulations. In fact, the former CFPB took the position that they were subject to those same payment regulations. And so that's sort of my view of the world, is not that it's unregulated and needs to be regulated. My view of the world is that regulators need to step up and enforce the law. And I would have no issue with crypto. I think I would not feel as strongly in my concerns about it if we saw the same type of regulation of crypto as we do to similar financial assets. Um, the reason crypto is so high risk as even a speculative instrument is because we don't have the fundamental protections that we've learned since the Great Depression are necessary for a stable financial system. And I'll go back to this idea of these concentrated platforms. We learned long ago that you don't want to combine the activities of banking and securities exchange and broker dealer and all these things without having really tight walls against the conflicts of interest that are generated there. And I think the FTX collapse showed us that there's not just a danger of fraud, but there's a danger of not following all of these lessons we've learned from history about the right way to regulate financial markets. Crypto is not running under those that learned wisdom right now, and as long as it's not compliant with those laws, as long as it's not protected the same way the rest of our financial system is, I think it is a heightened danger to consumers and should be approached with a lot more caution.
Well, thank you. That was a great wrap up of crypto and kind of the dangers behind it. And yes, as Angela Coder just said, well said. So with that, thank you both so much for this presentation. That's a lot of information, and I can't even tell you how impressed I am, Corey, that you can pull all of that information out like that and just, talk about it like it's every day. But I suppose it's every day your work, but really well done. And thank you so much to both of you for taking time today. And with that, I am going to, oh, and by the way, I want to let people know those who put some stories into the chat, I am going to pull those stories out and give your contact information to Corey and to Sharon so that if they want to ask you anything further about those stories or use those stories in any way, they can connect with you. If you don't want me to do that, just send me an email at epepper@hsgcenter.org and I won't send your contact information. But with that, I'm going to hand it over to Bruce to wrap us up.
Well, nice to see all the warm responses and great job, Sharon and Corey. Thanks so much. And of course, this will be recorded and others can listen to it as well. Turns out our webinars have quite a life of their own after they've been done. So it's a resource you can tap into or share with others. And we have one more webinar coming up will be next week, right? And that's our annual AmeriCorps thing. And, I really think more people should take advantage of this. We have a number of people that got placed all through the United States through the AmeriCorps program. They're very bright people who have been real assets. Generally, they're not housing counselors because they haven't gotten their certification yet, but apparently some of them have been training and taking the tests. So that's a potential line. I know some people have been working in administrative roles and in outreach marketing. All of this is really valuable and brings new talent to the organization. There's some costs, and Corey will go through it, but it's not anywhere near like what it's paying for new staff, full-time staff under regular salary structures. So it's a great program. It's run by Housing Action Illinois, and they have a very good reputation as being one of the favored places in the AmeriCorps world. And this program seems to have continuing going, even though I know that some programs have been cut back. So please take advantage of it next week, and stick your head in. You'll find out what the opportunity is and how to apply. And it's hard to do this on your own, but it's much easier doing it through the Housing Action Illinois program. And they've been generous enough about making it available across the country. We are always looking for different topics. So if you've got challenging topics that you'd like to get area experts to talk about, or discussions that you think we should have on these, please let us know. We do love to get these ideas, and this is how the crypto one came to us. So please, we've got a clean slate, almost clean slate for 2026, and I know you'll give us some ideas. Want to just also please, if your organization has not joined yet, please get on it. This is what keeps us going. It gives us independence. It's a substantial part of our budget, and you get lots of value out of it. You can save a lot of money on credit reports and other pieces, depending on what you need. But all of us pull credit reports, so that's an easy one to identify and cost it out. But we want you to join mainly because it's part of joining the joint effort of supporting housing counseling. And we want to be around for a long time and continuing doing this work. And we know you do too as well. So please make it a point of joining or renewing this year. We actually had a very good, strong year up until this last month, and things have slacked off some. So we watch these things very closely. So please do join. And if you haven't joined you haven't done your 2026 uh, membership dues, we unfortunately have now taken the hard step of pulling the credit report discount off of those accounts, and that will probably start showing up this month on people's bills. And that's, generally, I think for most of you, that'll be saving over $7 per credit report. And that can be a lot of money. Just do the math on how many credit reports you pull in a month, and you can see what it's like, and then certainly a year. But we really want you to be members because you're supporting the work in general, because that's what we want to do, is support you. So with that, thanks so much. Let's talk to you next week. And let's please call your offices, your House and Senate offices, especially Republican offices, about supporting housing counseling in the appropriations process, or talk to the leadership. So calling your office and asking them, Republicans especially, to talk to their leadership about getting full funding for housing counseling, and secondly, for making sure that housing counseling provision is in the road bill. Those two things are, we think, really valuable for the long-term success of our work. So thanks so much. Let us know if you get any interesting responses, and we'll talk to most of you next week.